Welcome back to Let's Talk Forex with Alison and Chris. So today we're going to be talking about a topic that is quite challenging for many traders, and that is mean reversion trading strategies. In this video or this podcast, we're going to be showing you what the strategy entails, common pitfalls of trading mean reversions, and then we're going to give you some detailed trading examples.
Hey, Alison.
Hey, Chris. How's it going?
Yeah, pretty good, thanks. Pretty good. How are you?
Yeah, very good. Thank you. It's absolutely beautiful here in Kenton. I must say it's been the best weather I've seen for many months, actually. It's been very calm, very hot days. So I can't complain. How's it going in Portugal?
Yeah, no, it's great. Still the tail end of summer here, which is lovely. It's been about 23, 24 degrees. We're down, went to a surfing town called Ericeira this last weekend. Sat on the beach.
Oh, I saw.
Yeah, and ate my body weight in seafood. Yeah, fantastic. No, it's really lovely this time of year, actually. As you say, very settled weather. And we've had it's been very unstable a lot of the summer. So it's nice to have some calm, peace and quiet and some sunshine. But it's all going to end very soon, of course. I mean, it is the Northern Hemisphere and it is November. So I'm sure it's going to start getting cold, but enjoying it while it lasts.
So what are we talking about today?
So yeah, today we're talking about mean reversion, which is, it's all the idea that prices are going to revert to their average after moving too far away from the average. The common analogy is imagine a rubber band. When you release the rubber band, it snaps back to its original size. And the key with mean reversion is figuring out when that snapback is going to happen. And it's really important to time your entries and exits once you figure out, or once you have a good idea when that snapback is going to occur. And you really don't want to get caught up in a continuing trend. So there's a couple of things happening here, and we're going to try and split it up and explain it to people.
Yeah, exactly. As you mentioned, Chris, you need to be quite selective in which types of market conditions you apply mean reversion strategies. Of course, if you've got a very strongly trending market, you really do not want to be applying mean reversion trading strategies, because you're definitely going to get stopped out or fading that, lose a lot of money. You know, it's really best used in ranging or very low volatility markets more than anything else. And a classic tool for spotting mean reversions is Bollinger Bands. For those who aren't familiar, Bollinger Bands are basically two bands with a standard deviation of 2 and a moving average of 20. That's if you're using the default settings. And when the price breaks above or below these bands, you can sort of be sure that price will revert to the mean or back to the moving average. So, for example, if you have Euro USD and you have the price spiking above the top Bollinger Band during a quiet trading session, you don't want to be doing this when the bands are very far apart and you've got the price moving very strongly in one direction. You really want to apply the strategy when you've got more of a range and not very big moves happening. Then instead of chasing a move in a trending market, a mean reversion trader would consider going short, expecting the price to reverse and go back towards the moving average. So in this type of setup, you'd look to enter a short position on the first red candle that closes back inside the band. And then you'd obviously place your stop loss above the recent high and your target possibly at the level of the moving average or the 20 SMA.
Yeah, that's a really great example, Alison. And I think you've done a video on Bollinger Bands, haven't you? And I think we should probably link to that in the show notes so people have a better idea of what you're talking about.
Yes, I think we've done 2 actually on Bollinger Bands. The one involves the RSI, and that actually looks at more trending markets. But there is another one that we've recreated on Bollinger Bands in a range and how Bollinger Bands work.
Yeah.
So yeah, we'll pop a link to that in the notes.
We'll pop that into the show notes so people, it's kind of a visual thing. It's well explained. But yeah, that's a really good example. But one of the biggest mistakes that traders make with mean reversion is averaging into losing trades. It's tempting to think here that the price, is even further from the mean now. So it's bound to come back here. It's going to come back to the mean. But this kind of thinking can quickly lead to large losses. You've got to be really careful with it, especially in a trending market. There's an old trading saying, I think it's Paul Tudor Jones actually said, losers average losers. And this is a reminder that adding to a losing position in hopes of a reversal is a risk. And it's something we talk about a lot, and it's something that you should avoid at all costs. So particularly with mean reversion strategies, it's really important to make sure you're not applying the strategy in the trending market.
Yeah, I mean, instead of averaging down, a better approach is to wait for a reversal signal, like an engulfing candle, for example, or a shift in momentum. So another great setup that you can use in this regard is the double top trading pattern. Again, we've done quite a lot of videos on this as well. So if you have, for example, the GBP USD and you see that it's rallying and it forms a double top near a strong resistance level, and you find that the price tests that level again and then forms a red candle, this could be your signal to go short. So you'd likely set your stop above the resistance level, and you'd set your target at, say, a 2-to-1 risk reward ratio. You have to be quite careful with how you set your stops and your targets though. But that's a whole another topic. We're sort of just giving you some examples of how you can trade mean reversions using these trading patterns.
Yeah, and we should put a link. We'll put a link to your video on the double tops as well. I think in the show notes, people can see what you're talking about there. And for intraday traders, using the VWAP, the volume weighted average price, can be a real game changer here as well. So imagine you're trading, let's say, an index like the S&P 500 as CFD, and after a strong morning rally, the price is far above the VWAP. But when the VWAP flattens out, it indicates that momentum is slowing in the market. This is what it is, momentum indicator. And it's really good for checking this. And obviously, that's very good for telling whether a market is trending or not. So you can enter a short trade at the first sign of a reversal, let's say like a bearish engulfing candle or something similar, and you set your stop just above the high of the day and target that return back to the VWAP.
Yeah, exactly. And I think that's a very important strategy, a very important mean reversion trading strategy. I know a lot of traders really do rely on that strategy. So if you are interested in looking at the VWAP, you might want to just do a little bit more research on that trading strategy. Then another strategy that I find is quite popular, but one that's slightly more risky and difficult to pinpoint is the flush and reversal trading strategy. So it basically occurs when you see a sharp move or emotional move at the end of a trend, and you often also find a spike in volume. So if you're looking at, for example, the AUD USD, and you see it's been in a downtrend for a while, and suddenly it prints a very large red candle with increased volume, it might be the flush of sellers, that there are a whole lot of sellers coming into the market. But in this case, you actually might want to wait for a green candle, the printing of a green candle, to signal a reversal. So you might wait for an engulfing candle or just a large green candle to occur, and you'll place your stop below the level of the flush and then target maybe a pullback to the mean.
Yeah. I do love the flush and reversal setup. It's but it's all about recognizing when the market is stretched too far and is likely to snap back here. And it's this setup, as you said, it's risky, requires strong discipline and really tight risk management, because without a predefined stop loss, you can easily get caught out if the trend continues in the market.
Yeah, absolutely. I mean, that's absolutely crucial, is strong risk management. Just because the price is far from the mean, it doesn't mean that it's guaranteed to reverse.
Absolutely.
And that's why, no matter what strategy you're using, it's very important that you use, particularly for mean reversion, I guess, tight stops, and that you limit your position sizes, especially when you're still getting used to trading mean reversion strategies. And another great filter to use if you are going to be trading these strategies is the 200 moving average. So if the price is well above or below the 200 period moving average, it's often better to avoid mean reversion strategies. But if you find that price is sort of oscillating around it, it could be a good indication that a mean reversion strategy is the right one to trade in that market condition. Yeah,
it's a really good point, Alison. And I think the key takeaway here for our listeners is that mean reversion strategies, while they're powerful and they can be very useful, they're not suited for every market condition. They work best in range-bound markets, or, as we said at the beginning, low volatility markets. And it's crucial to use strong risk management to avoid getting trapped in trends. And because we know that, most markets do move in trends. So in a lot of cases, a mean reversion strategy is not going to work. So you got to make sure that you're using it in the right market conditions. And even then, make sure your risk management is super tight.
Yeah, that's very well said, Chris. And, I think if you're interested in trying out mean reversion strategies, always start out with small position sizes, back test your trading strategy, and then focus on disciplined risk management. I know it's something we go on about all the time, but really, as traders, you're managers of risk. So please just ensure that if you are going to be trying out a new strategy, you focus on setting your stops and your profit targets at reasonable risk-reward ratios, because this way you can really capitalize on those market snapbacks without exposing yourself to too much risk.
Yep, exactly. A really good point there, Alison. Yes, you're risk managers as Forex traders. And this is, but the mean reversion strategy, what I like about it is, a lot of beginner traders are like, how do I trade when it's not a trending market? When you don't have these signals that normally does and that you normally have. And, this allows you to do that. It adds another arrow to your bow. It gives you another option.
Absolutely.
Yeah, it's fantastic. So as always, if you've got any questions or you want to hear more about our trading strategies, other trading strategies, then feel free to reach out to us. You can get in touch with us at podcast@fxscouts.com. And we're also available on social media, or you can just pop a comment below this video and get in touch with us that way. And remember, the key to successful trading is preparation and patience.
Absolutely. Cool. Thanks so much, Chris.
Thank you, Alison.
And we'll see you in the next video.
Speak to you soon.